Hey, Jason here. Today's video we're going to do more in-depth analysis of Widepoint. Why? Because it looks like a great stock on the preliminary analysis, on the visual preliminary analysis. Now this is stage 2 in my analysis structure, looking at the actual financials, doing the visual financial analysis, taking it into the written financial analysis, also doing some basic valuations as well to see if I want to take it further. Before I get to that though, I need to let you know that you can get this series of podcasts anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video and our other videos, make sure to hit the subscribe button and also hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay, before I get into this, the actual analysis, I have to do this disclaimer. I'm sorry, I don't want to do this, but I have to do this because every time I don't do it, I get nasty comments. I do not short sell ever, so any stock I talk negatively about, I don't profit from. I don't own any stock in a long position, and any stock I talk positively about. These analyses are done for your purposes only, at the request most of the time of viewers, to help educate you on how to become a better investor. Why should you listen to anything I have to say? Because in the first 9 years of my career, I produced average annual investment returns for the portfolios I managed of 23.5% per year on average. That puts me just behind the great Warren Buffett at 24.2% in the first 9 years of his career, and legitimately makes me one of the best stock pickers in the world over the last 9 years. I'm not saying that to brag. I'm saying that to prove to you that maybe I actually know what I'm talking about a little bit. This stage of things, I don't care about the company's story at all. I follow what the numbers tell me only. I don't care about what it says it's going to do in the future, anything like that, until, again, still far later in the analysis than this. Because I haven't done one of these analyses in a long time, no matter what I say in this analysis, this is, again, still for your educational purposes only. And I do not own stock in this company, and I do not short sell ever. Okay. Again, I apologize for that. I don't want to say that stuff, but I have to, because every time I forget, I get nasty comments. So, Widepoint. And what you're about to see is the actual analysis I go through every time a company surpasses stage 1 of my analysis, which Widepoint did, and I'll link to that video below this. That'll be linked for free below this. And this analysis you're seeing right here is a previous analysis I did with a student of mine. But this is the exact process I go through every single time I evaluate a stock at this stage. I think it's US dollars. Actually, let me get this screen out of the way so you can actually see. There we go. So, yep, US dollars. Okay, its market cap is 65.5 rounded up. No dividend. Okay. Oh, and for those of you who just want a quick recap of why we're searching over Widepoint, this was requested by a viewer, and it looks actually like a great potential stock on both the metrics and also the valuation as well, which is why we're doing this full analysis today, to find out for sure before going to my next stage of the analysis, which is actually looking at the company's 10Ks, a proxy, stuff like that. Okay, and I'm going to pause this on occasion just so you guys don't have to see me calculate the numbers, because I'm sure that's going to bore you. Negative 1.5%. I look for anything above 10% on a consistent basis here. So this does not surpass my threshold. If memory serves me right, the company looked fantastic on the numbers, on the initial numbers, and they had some huge potential competitive advantages that we needed to follow up on, if memory serves me right. Okay. Rose, and in 2011 to 9 million in the trailing 12-month period. increase of... If you want more further explanations of why these numbers are on here, go back to the other Widepoint videos, or the other Widepoint video, or the other videos in this series, which you can get linked below. I'm going to save some time today and not explain those here. So if you want to see what those are and why I have these on here, why they're so important, the multiple things they can show you, the multiple things you can learn to find potential red flags, potential good things about the company, make sure to check out the Widepoint video below and the other videos in this series as well for free. Increase of 50%. Book value per share. Rose from 2011 to 4.65 per share. Oops. 31% rounded up. That's good. Share count rising isn't great, but it's not a huge increase here. Book value per share going up is a good thing here generally, and we'll see that in a second, if goodwill isn't part of that, that's generally a good thing. Again, for further explanations to all this, go to the previous video. ROIC 26.4%, which is spectacular. I look for anything above 10% on a consistent basis, but this is also what I look at the 5-year numbers. Okay, Widepoint. ROIC 5-year average is not great though. Which, frankly, I mean, they're a growth company, so it's not surprising that they were losing money for a while, and then now they're making a huge amount of money. So, not a huge red flag either way so far, although, again, not great over the long term. Oops, forgot about the ROE. Okay. 6.4. Okay, I'm going to talk about this here. So this is an illustration of how ROE, which I talk about, and the only reason it's on here is to compare to ROIC, because if I know for example, let's go back over here. If ROE is higher than ROIC, which it is at 30.7% in the trailing 12-month period versus ROIC of 26.4%, I automatically know the company has debt, a decent amount of debt, not a huge amount, but small amount of debt. But this works well when you're earning money in a positive sense. Debt is leverage. This also works against you if you're losing money, which it was in 2017, which is why its ROE was lower than its ROIC, and they're both negative. So this is a perfect illustration of why ROE is levered by debt and how debt can affect the company in terms of their profitability. Looks for anything above 5% on a consistent basis, so it again doesn't meet my threshold. Okay, so I go over to my notes over here. Make up 20.8%. Short-term debt makes up 0. Long-term debt 0. Cash position. Why is this important? the net cash position, because that means the company, that gives the company more margin of safety. They have more cash than they have debt. Gives the company more margin of safety. No other major notes here. Accounts receivable is huge. Yeah, no other major notes here though, so I would delete this and come back over here. Cash conversion cycle is negative. -1 days, and what year is that? 2012. 2. Okay. Why is this important? This is one sign the company's becoming more efficient over time, which illustrates here in its margins in a real world sense, because its margins have improved over this time period. Its free cash flow has improved, its operating margins, its ROICs, they've all improved. This is one illustration of that. The company becomes more efficient, margins go up. That's why this number is so important, and for other reasons that are in the other trainings about cash conversion cycle. Okay, so now enterprise value. Market cap is 65.5, and I need to change this because billions and millions is a huge difference. 65.5 minus cash. $17.1 rounded up. Oops, got to go into the actual balance sheet because it doesn't show short-term investments there, it just shows cash and cash equivalents. But they are the same thing in this case. In some cases they aren't though. I just want to be safe. Short-term debt and capital leases is short-term debt, capital leases 0.58. Long-term debt is 5.78, and they're all in capital leases. That's another reason to look at this. Preferred stock, I would assume they don't have any. Oops. Because most newer companies do not have preferred stock. Let's go down and check. Yeah, no preferred stock right there. Minority interest. And again, I would assume they don't have any because most companies do not, but I just want to make sure. And again, I do not see any minority interests, so we're done here. Let me calculate this out. Okay, I finished the calculation, and I'm highlighting 54.76 million USD is the enterprise value. That being lower than the market cap is one sign the company is undervalued, or might be undervalued. We're about to find out more about its valuation. 54.76 by bringing this number up here. And again, hopefully you can see all this. I've not done the dual screen thing very often, so hopefully you can see all this. If not, I apologize. But that's also why I'm saying the other numbers as well. So EV to EBIT, we need to go find its EBIT, which is also known as operating income. And that is, we need to go to the actual financials because it's small. So I need the rounded up number. Operating income 3.16. So 54.76 divided by 3.16, 17.3. And EV to free cash flow, 54.76 divided by cash flow, which is 0.9 7.73 it looks like. Divided by 7.73 equals 7.1. So this is interesting. Before I get to that, let's do the inverse of these. So the earnings yields, do the inverse of these. These are relative valuations, EV to EBIT, EV to free cash flow. I look for anything below 8. One is at 17.3, EV to EBIT. EV to free cash flow is 7.1. For this business, free cash flow matters more, in my opinion, based on their business model. So I'd lean closer to them being undervalued, because this being at 17.3 would show they're overvalued, but their free cash flow 7.1. That would lean me to say that they are probably slightly undervalued. But the earnings yields of these, EBIT to EV for EV to EBIT, and free cash flow to EV for EV to free cash flow, you just do the inverse. So 3.16 divided by 54.76 equals 5.8%. And this is 14.1% rounded up. What these illustrate, or what these show you, is the amount you should expect to earn owning the stock in the next year based on its current numbers only. And when I say expect, that's the key word, because these never really figures out to that same amount about. But this looks like it might be potentially undervalued. Metrics are okay, or the metrics are good now. Metrics are okay over the long term. If the company sticks to its current trajectory, the company is significantly undervalued. If the company falls back to its kind of historic numbers, the company is drastically overvalued. What I would want to figure out is, and I'd have to go into the financials to figure this out, is which trend do I expect to continue happening? The one of the last year, the one of the last 5 years? Frankly, again, because of this business model, I would expect it, based on preliminary knowledge of the business model and the company, to be more of what it's doing now, and what it's done in the last year. However, to kind of confirm that, I would need to go look at the annual report, stuff like that. What else? Oh, this one over here too, ROIC. Let's do this one, because I don't know what goes into Morningstar's ROIC calculation. I do know what goes into my ROIC calculation, which is right here. ROIC for my calculation is EBIT divided by, in parentheses, shareholders' equity plus debt and debt equivalents minus cash and cash equivalents and other investments. That is my ROIC calculation, which, to find that, we need the balance sheet. I'm on the cash flow statement, which is why I can't find the shareholders' equity. And I apologize if you can hear my daughter in the background. She's yelling all of a sudden. 42.22. Oops, gotta bring the EBIT over first. 0.16 divided by 42.22. The shareholders' equity. Short-term debt is 0.58. Long-term debt was 5.78. And cash and cash equivalent was 17.1. Okay, so I'm going to calculate this out again. I'll bring you back in a second. Okay, so here is their final numbers down here, and then their actual ROIC is 3.16 divided by 1.5 equals 10%. So that is significantly better than, actually it's not better than trailing 12-month ROIC. It's worse, but because again, I don't know what goes into Morningstar's numbers. I calculate this for every company I look at, and I go based on my number. 10% is good. I look for anything about 10% on a consistent basis. So this looks like a good potential investment to continue researching. Looks like it might be undervalued. Margins, if they stay good, are good. Or if they stay out as they currently are, they're pretty good. If the company, again, to kind of recap, If the company sticks with its current margins, sticks with its current profitability, it's undervalued. If it does not, if it reverts back to its prior, the 5-year averages, it's significantly overvalued. One way you can do that is to do a basic valuation, which is not this. It's a different thing. So this is one of the valuations I do. I don't know what it's called, but I always just call it EBIT multiple plus debt minus cash, I think. Let me not guess. And go over here. Valuation profitability metric template that you can get as one of the free bonuses in the 5 free gifts, which you can get below. Where is it? EBIT valuation. There we go. And this is for students. This I usually get for students, but again, you can get this as well. Oops. Messed up the formatting. Messed up the formatting. Messed up the formatting. Sorry, I'm a little OCD about this kind of stuff. Okay, so we have the definition here. Trailing 12-month EBIT. Again, hopefully you can see this, but I'll read it just in case. Multiplying this by 8 and 11, trailing 12-month EBIT, then adding cash, subtracting debt, and divided by the number of diluted shares outstanding to find out per share price. And I've done this. I do this for pretty much every company I look at because it's such a versatile valuation. You can value any company like this as long as they are producing positive operating profits. 3.16 times 8 equals 25.28 plus cash and cash equivalents, which is, let's get this out of here, let's get this out of here. Cash and cash equivalents of 17.1 minus short-term debt 0.58 minus long-term debt 5.78 equals 36.02. Oops, that's definitely not billions, that's millions. $1 million. Okay. This being lower than the market cap means the company is overvalued by about almost double using this valuation. This is only one of 23 different valuation techniques I teach though. So again, over here, slightly undervalued, slightly overvalued. This is showing as overvalued as well. Another one you can do is instead of doing, you can use this free cash flow as well. So 7.73 times 8 equals 61.84 plus minus 1.58 minus 5.78 equals 55.48. So looking at with free cash flow, even the company is overvalued, but not by a huge amount. So what this shows me is, again, the company had a great year in 2020 with its free cash flow. If it stays on this trajectory, again, based on what I showed over here, the company is undervalued. However, if this dips back to kind of the more normal range, the company is significantly overvalued. This proves out what my thesis was over here, based on the relative valuation. This proved this out. So what this means is this company is interesting, frankly. Even more interesting now than it was in the first video. What this shows me, to kind of recap everything, and I'll bring in my face here, is, let's go back to my face. Can you see my face? You cannot. There we go. What this shows me with this analysis is I need to do further research on this company. This frankly muddied up the analysis a little bit, because at first look it looked like a great potential investment. Second look, it still looks like a good potential investment, not a great potential investment. There's some mixed signals here in terms of the margins. Are those going to go back to what they were? Are they going to stay what they are now, go even higher? And then overvaluation on some metrics, or undervaluation on some metrics. So the company at this point, it's kind of a mixed bag, frankly. Still looks like a great potential investment though, depending on what the next stage says, which the next stage for me. So these are the first two stages of my analysis process. Third stage is actually looking at the most recent 10K, most recent annual, most recent proxy report, which I'll bring to you at some point. Frankly, that takes a little bit longer, but I'll put that on my calendar, and I'll actually remember to put this on my calendar because who was it? I can't remember who. I think it was FDA on YouTube reminded me about this because I went on vacation and I actually forgot about it, and then I got busy getting back from vacation and family stuff and all that, so I actually forgot to do this. So thank you to him. I think the picture I think is a male. So him, her, whatever you are, whoever you are. Thank you. Thank you for watching. Thank you for commenting. Thanks for reminding me to do this. But I'm going to put this on my calendar right now to do this, my third analysis of this, which is going through the financials. When I say going through the financials, I mean reading them word for word. And I don't know how I'm going to do that yet, because I've done that with students and it's about as fun as you might think. But I will show you definitely what I'm looking for, what I'm seeing in the financials, the notes I take, all that. That'll come up in the next video on Widepoint, and we'll continue on this analysis. If you like this video, make sure to like, love, share, subscribe, comment, hit the notification bell, all that good stuff. So you're notified every time we release a new video, because we release a new video all the time. If you watch it listening on the podcast, all that same stuff, we really appreciate it. We all really appreciate a review as well, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific help from me for free on how to become a better investor faster, you can check out our 5 free gifts, which is the full analysis template you saw over here. You can get this as part of that as well, along with 4 other free gifts. You can also get a free PDF copy of my book, How to Value Invest, as well, and you can also get a free copy of our guide, 7 tips to picking great stocks. 3 times you must sell. You can get all 3 of those for free at the links below. If you're looking for more specific help from me, please make sure to check out our masterclass below as well. I hope everything in here made sense. If it didn't, let me know in the comments below. But until next time, thanks so much for watching. Have a great day. Bye.